Hello again. This video is going to focus on where to take profit after entering a trade in a supplier demand zone. Due to the type of trades that we are making with the strategy being reversals, the name of the game is to identify where to take profit during retracements. Now, to know where to take profits during a retracement, we need to know where key levels are likely to be at. To do this, we will use the Fibonacci retracement tool. This tool essentially just calculates proportions of a move and allows you to see those proportions as levels during a retracement. When using this tool, there are a few key levels that I like to use for where retracements are likely to find support or resistance. With this strategy of entering using supply and demand zones, the key levels that I like to highlight with the Fibonacci retracement tool are shown here. We have the 0 level, the 0.382 level, 0.618 level, 0.707, 1 level, 1.414, and 1.618 level. Now, I will use each of these levels in my profit-taking strategy. But first, let's talk about how to use the tool. Being that the tool measures the proportions of a retracement, you'll use this tool to mark the relative high and relative low of a move. Which move we are looking to use is the move that occurs into the retest of the zone. So for this supply zone right here, if we were to look to identify an entry and establish a downside position, I would be using the Fibonacci retracement tool, going from the relative low to the relative high that was made within the zone. Keep in mind here what I'm doing. I'm going from the low to the high. Another good way to think about it is enter with the low that is created after the supply zone is made and mark it all the way to the high that was made within the supply zone. What you can note here is that I'm using the low that was established after the supply zone presented itself, and I'm using the high that was made in the supply zone. Similarly, if we are looking at a demand zone like this one here, the levels that I'm looking to plot with the Fibonacci retracement tool are the high that was made after establishing the demand zone, so that would be this high right here, and the low that was made within the demand zone. Once again, you plot this from left to right using these 2 points, and proportions will appear on your screen that can be used for the take profit strategy. Okay, so the strategy goes as follows. So this strategy involves selling some of the position at each of the levels and adjusting your stop loss along the way. First, imagine that our position size for each trade is 100 shares or 100 option contracts, depending on the type of trading that you are doing with this strategy. Anyway, after confirmation has been identified for an entry on the position, we use the Fib retracement tool to get our levels. The first price target that we are looking at is the 0.382 level. When this level is reached, take profit on 50% of the position and set the stop loss to break even. So if we have 100 contracts, you would sell 50 of them at the 0.382 level and set the stop loss on the remaining 50 contracts at break even. The next level that we are going to be looking at is the 0.618 level of retracement. If this level is to be reached, you are selling 50% of the remaining position, which means that you would take profit on 25 out of the 50 remaining contracts. At this point, your stop loss will remain at break even. Now, if there's to be a candlestick close through the 0.707 level on the time frame that you used to identify the entry, you would now set your stop loss to the 0.382 level, and you would only stop out if there is a candlestick close through that 0.382 level on the same time frame that you identified the candlestick close through on the 0.707 level. Now, with the remaining 25 contracts that you have, you are looking to ride those up to the 1 level of retracement. If the 1 level is to be reached, take profit on 60% of the remaining position, which translates to selling 15 of the 25 remaining contracts. From here, set the stop loss to the 0.618 level, and the next price target is the 1.414 level, where you are looking to take profit on 50% of the remaining contracts, which translates to selling 5 of 10 of the remaining contracts, and setting your stop loss to the 1 level. The final price target is at the 1.618 level, where you are looking to sell all the remaining contracts. Now, this profit-taking strategy works incredibly well with supply and demand trading. Okay, let us take a look at some examples of this taking profit strategy using the Fib retracement tool. To make things less complicated, we'll use the examples from the last video where we already mentioned the reasons for entry. This first example here goes over taking profit after entering a trade using this 4-hour demand zone. Recall, we identified an entry for a move off of this demand zone using the 1-hour charts, so we'll go ahead and use that to identify our take profit levels. Recall, we saw that falling wedge with that bullish divergence, which led us for a strong reason to enter this trade and ride it to the upside. But now let's go about and see how our taking profit strategy would work. First, we identify the high that was made after the demand zone was established, and we go all the way to the low that was established in the demand zone. So now we have our fib retracement tool. So let's go ahead and play this out and see what we would do at each of the different taking profit levels. And just to make things a little bit more clear, let's say that we entered 100 contracts down over here where we established that entry. If I go ahead and play this out, but at this point right here, where this candlestick broke through this level, I would look to go ahead and sell 50 out of the 100 contracts, selling 50% of the position and setting the stop loss to break even or where I entered at. Now to let this continue. At this point right here, where we just touched the 0.618 level, I would sell another 25 contracts, which is 50% of the remaining position, and set the stop loss still at break even. At this point here, where the candlestick closes above the 0.707 level, which is this green line here, I am looking to go ahead and set my stop loss to the 0.382 level now. My next price target is going to be at this one level up here. When the one level is reached right here, we would sell 15 out of the remaining 25 contracts and set the stop loss to the 0.618 level. Now, sometimes it might appear like this, where you get very close to the 1.414 level, which as we see over here, but not exactly touch it. It's okay to take profit there on some of your position, but remember, the rule is only set the stop loss to the one level if the 1.414 level is broken. So if we continue playing this out, now after that very long period of consolidation, the 1.414 level was eventually hit. And remember, at this point, we're just taking 5 of the remaining 10 positions. Now we can set our stop loss to the one level at this gray level and just let the rest of the runners do what they need to do, whether they hit the one level or the 1.618 level. We're selling all regardless. And after another period of consolidation, we see that the price did end up hitting this 1.618 level, where you would sell the remaining 5 positions. The reason we don't swing for a home run and just look to take profit on the final profit-taking level is because it is not certain that that level will be hit, and it is best to reduce risk in the trade by having multiple profit-taking levels and adjusting the stop loss accordingly. Also, if you were playing option contracts, they would have likely gotten eaten up and their premiums would decay in these periods here and here where we saw that long consolidation. That's why it is best to secure that profit going into strength, and where strength is likely to end is at these resistance levels. But let's take another look at an example of this profit-taking strategy. Here is a 30-minute supply zone, and recall we did use the 5-minute time interval to identify where an entry would be. Of course, we saw this bearish divergence with that wedge pattern, and now if we want to pull up our profit-taking levels, go from the low all the way to the high. Notice this was the low that was made after the establishment of the supply zone, and this was the high that was made in the supply zone. So you guys remember the profit-taking levels. 0.382 is our first, 0.618 our second, one level is our third, 1.4 is our fourth, and of course the 1.618 is our fifth and final profit-taking level. Now, it is definitely okay to only use 3 profit-taking levels. Say if you wanted to just use the 0.382, 0.618, or the 1 level. Keep in mind that you do not want to have your profit-taking level too far away from your entry, or else the profit-taking level may never hit, and your stop loss might cause you to lose money. Let's go ahead and play this out and see what we would do at each of the different levels. Okay, so we got a very quick move. If we were watching this real time, we would have taken profit on 50% of the position here, setting our stop loss to break even. Right at the 0.618 level that happened on that same candle, we would take that other 25 contracts off the table, setting our stop loss still at break even. But with this candlestick right here that closed underneath of the 0.707 level, we would adjust our stop loss to the 0.382. And when this one level was hit, we would sell 15 out of those 25 remaining contracts. Now, if I continue playing this out, you'll notice that the stop loss would have actually hit and the further two price targets did not hit. However, think of it like this. For 50 contracts, we took profit here. For another 25 contracts, we took profit here. For another 15 contracts, we took profit here. And that means with just the last 10 contracts, we still took profits in the profit-taking zone. So we didn't sell any of those for a loss. And the main thing that we're looking at here, guys, is do not let your contracts go red after they're green. That's why after we take profit the first time around, we set the stop loss to break even, and we never go beneath that. Okay, let's look at one more example of this so it can be better understood. This last example here uses a 10-minute supply zone where we use this same time frame to identify an entry through the confirmation of this candlestick here that formed a bearish engulfing pattern. So now it's time to identify the price targets. Let's go ahead and pull those out. Remember, we're going from the low that was created after the establishment of the supply zone and going to the high that was made in the supply zone. Now, if we go ahead and watch this play out, at this point here, when we touched into the 0.382 level, we would look to go ahead and take profit on 50% of the position. If you're wondering why we're watching this on the 10-minute time interval, is because remember, we're still using the same interval that we used to identify our entry. So we're at the 0.382 level, take profit on 50% of our position, and we set our stop loss to break even. If I let this continue, the 0.618 level is hit, and I would set the stop loss still at break even, but still taking profit on 25 of the 50 remaining positions. Now, if we let this continue to play out, you'll see that there was no close beneath the 0.707 level, so we wouldn't adjust our stop loss, but look what happened. It eventually ended up going back to our break-even levels, and we would have stopped out for that break-even there. Now, this is a great example of why having different price targets and scaling out accordingly is a good thing. Two of the price targets were hit, the 0.382 and the 0.618, where we still were able to take profit on 75% of the position, and the remaining 25% of the position we still sold for break-even, which allowed us to profit greatly on this move. Anyway, you are free to adjust this profit-taking level to fit your needs, but this is the strategy that I have seen to work quite well when trading with supply and demand zones. That will do it for this video, and in the next video, we'll go over when a supply or demand zone is invalidated.